What's up everyone, it's Scotty with MoneyVest. So in this video, I'm going to break down the JOLTS numbers that came out earlier today, which basically sparked a sell-off in the market. And I'm going to go over and break down and explain to you guys exactly why that happened. Some comments from Ray Dalio. And of course, we have to talk about the bond market because, man, it's getting out of hand. We are seeing the 10-year yields, of course, continue to rally, now at over 4.75%. And there is possibility that we do see highs of 5%, if not higher, as there continues to be more and more auctions in the US with respect to the level of debt that's hitting the market. And who's going to buy that? Who's going to buy it? You tell me, because I don't know. But as always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board. The first week of the month is the best time to choose. And of course, if you want to make smarter decisions, find out exactly what we're buying, when we're buying it, of course, how we're trading options, intrinsic value spreadsheets, research reports, everything is going to be part of the MoneyVest community and our Discord. So link's going to be down below and we'd love to have you on board. So first things first, let's talk about the JOLTS numbers. 9.61 million job openings in the month of August. That's a pretty significant number. Consensus 8.75. So we are definitely coming in with a huge, shocking surprise on the upside. Now, the reason why this is a bit of a problem. Now, if you come over to where the markets are, but I'm going to just get rid of these. If you come over to where the markets are at the moment, they started selling off right at 10 a.m. And to the point where if you basically go over to the 5-minute chart on the NASDAQ, I'm just getting another alert on the 10-year yields. I don't know if you guys can see this, but this right here is the alert that just went off with the US 10-year crossing 4.778. Getting up to 4.78. But this right here is the 9:55 a.m. And this is the big candle at 10 a.m., right? So this is literally the 10 a.m. candle where NASDAQ dropped a little bit over 60 basis points. And from those levels, we are down over 1.68%. If you come over to the S&P 500, in other words, SPY, this is the 10 a.m. candle, 10 a.m. Eastern candle when JOLTS numbers came out. And since those levels, we are down another 1.25. And the Dow Jones also dropped a little bit over 110 points at 10 a.m. And from those levels, we're down 375 points. So it's not a surprise that as soon as the JOLTS numbers came out with such a shocking print, we saw the markets rotate back lower. And not to mention the US 10Y, which is the 10-year yields, started pushing higher right at 10 a.m. as well. So this right here was the 10 a.m. candle. And since then, we have pushed up over almost 2%. And now they're sitting at 4.785%, up a little bit over 2.2%. There's a lot for us to break down and unpack in this video. I want you guys to watch it all the way through the end to get a better understanding on what the heck is going on, because we're hitting the highest levels from 07. Now, 9.61 million is the number of job openings. If I plug this number in to our spreadsheet, our unemployment spreadsheet, which we've been tracking for quite some time, right now we know that it's 8.9, which was the previous number. So 8.92 was the prior number, which has been revised up to 8.92. If we plug in the number of 9.61, look what happens to this ratio. I want you guys to focus on this ratio specifically, not worry about anything else. Just focus on this ratio right here. So 9.61. Hit enter, it goes up to 1.51, meaning now there's more job openings per person than there were 1 month ago, right? What does that tell us? That continues to tell us that their businesses are hiring and there is opportunity for employees to, once again, find good jobs. It's this ratio, if it goes up, that tells us that there are more jobs available per person, right? The moment this ratio starts to drop below 1 is what the Federal Reserve wants. They want this ratio to hit an equilibrium. Equilibrium meaning the demand and supply in the jobs market. They want this to be balanced. And right now it is not balanced because there's more job openings compared to the number of people looking for jobs. And until this number comes down to more modest 1 levels, preferably under 1, is when we can start to expect the Federal Reserve to pull back from interest rate hikes. Because if this is 1.51, right, and JOLTS numbers at 9.6 or even as high as 10 million, and unemployed persons stays at 6.3 or 5 or 4, well, you better believe it, that continues to suggest the economy is strong, the labor market's strong, and well, guess what? That paves the way for the Federal Reserve to keep rates higher for longer. If anything, raise rates, continue to raise rates if inflation doesn't come down fast enough, right? What we want from a rate cut perspective is for JOLTS numbers to come down, right? A better print would have been from 8.2 million down to, let's say, 7.5. Then this ratio would have been a 1.18. Now imagine if this number would have been at 7. It would have been 1.1. If this number comes down to 6, we're now sitting at under 1, right? That's what the Federal Reserve wants. They want an equilibrium in the labor market with the demand and supply of jobs. Unfortunately, we did not get that. Well, we did get 9.61, which brings this ratio back above 1.5. Now, unemployment numbers are going to come out on Friday. That's the first Friday of the week, first Friday of the month. And we better believe it. If this unemployed persons goes down, right? If it goes down to 6 million, or if it goes down to 5 million, if it goes down to 4 million, you better believe it. Markets are not going to like that one bit. They're absolutely not going to like it. What we want to see is unemployed persons go up 7, 8 million, 9 million, so that that ratio continues to come down, right? That's exactly what the Federal Reserve is trying to do. They're trying to compress this ratio, which has obviously come down from 2.5 down to 1.5 now. But of course, we did see an uptick in this ratio. So that was the main reason. Now going over to some of the catalysts here. Traders dumped a record $40 billion of stock futures in the past week. That is a record. So hedge funds that used managed futures strategies recently unwound positions in the S&P 500 futures at the greatest speed and magnitude on record is what Goldman Sachs mentioned. And with the most of these positions now squared away, Goldman claims, quote, "We are closer to the end of this selling pressure than not. Negative market sentiment is everywhere. Having a bearish outlook is gaining traction, possibly consensus. That has doubled since July, and bears now outnumber the bulls 1.5 to 1. Where are you guys? Where are the bulls at? Where's the bulls at? It's all bears right now. It's all bears territories. And right now they do outnumber the bulls by 1.5 to 1. And this right here was the catalyst that also came out earlier today. Ray Dalio says the 10-year Treasury yield could rise to 5%, and there's risk that it goes even higher. And Ray Dalio, obviously a very, very renowned and popular macro investors. I like to look at what he's talking about. I like to listen to what he's talking about almost all the times because he, looks at the big picture. He connects the dots really well. And he focuses on the macro thesis, which is, again, the economy and how they are kind of comparing against with the debt levels, credit crises, all those different things. And there is obviously a level of deficit risk that he's mentioned, and we've talked about this in one of our previous videos, where the Dalio said that imbalance of government's debt supply and demand picture also caused yields to go higher. Yields and prices move in opposite directions, as we already know. But because of that imbalance, it is not surprising that we're seeing the yields get up to as high as 4.7.5%. And of course, they're sitting at their highest level since October of 2007. He further goes on by saying that, quote, "We have an abnormal amount of supply. The situation in that the quantity of debt that we have to sell and the amount of government has to sell is a lot. And it remains a lot, and buyers are less inclined to buy the debt for a variety of reasons. Now, the widely followed investors believe that in the current environment, cash looks to be relatively appealing. Dalio, of course, had been calling cash as trash, but since the purchasing power of cash diminishes amid rising inflation, but he changed his point of view earlier this year because money market funds, even your normal online savings accounts are paying you a positive real interest rates considering how inflation has come down and interest rates have gone up. So as a result, it has something like a 1.5% real return, not bad in comparison to other things, and it doesn't have price risk, meaning that it doesn't move all that much, right? Bonds, if you buy bonds, of course, it's got the price risk because as yields go higher, prices continue to come down and you'll have an unrealized loss on the portfolio. But of course, you can hold it till maturity to get your principal back, but it definitely does have that price risk in the short term. So because of this deficit risk, we've talked about the supply-demand imbalance in the Treasury market. And to make matters worse, the U.S. government has another $300 billion of issuance of treasuries hitting the markets this week. So we got auction dates on October 3rd, October 4th, October 5th, the 10th, and the 3rd, right? So all of these are hitting the markets. Offering amounts going to be right there. So that's another $300 billion coming our way, investors' way, that needs to be absorbed. If not, then of course, that's going to be oversupply. Prices continue to struggle and yields continue to go higher. So, it's just one of those things where it's just a matter of patience and being disciplined because, yields are obviously moving higher. These are levels that we haven't seen in 16 years. But at some point, we're going to start to find ourselves more normalized once the U.S. starts to, slow down on their amount of auctions that they're doing. And at the same time, of course, Federal Reserve needs to make a decision after looking at inflation data, unemployment numbers, whether they need to raise rates, keep them where they are, or start cutting rates. But, for some reason, I do believe that one more rate hike is possible. I know I've been getting a lot of, what is it called, some pushback on that assumption or that analysis that the Federal Reserve is probably not going to do that. But look, guys, I mean, given how strong the economy is, with the JOLTS numbers coming in so strong and that ratio once again popping back above 1.5, if inflation doesn't come down to 2%, the Federal Reserve is going to use that opportunity. They're basically punishing the economy for being too strong. That's what they're doing. I've mentioned this before, but it's possible. In my opinion, it is still a likely possibility that 25 basis points is still on the cards before the end of the year. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. Be patient. I think it's going to take some time for the markets to normalize a little bit here because, we're seeing a pretty significant sell-off here. NASDAQ down about 1.7%. We've got the S&P 500 down a little bit over 1.4, starting to break down below 4,300 here. And that, uptrend channel, and the Dow Jones is down a little bit over 400 points, with, of course, the 10-year yields hitting highs of 4.78%. So hope you guys enjoyed it, found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing, and I'll see you all in the next video. Take care.